Hi there, my name is Ashley Micciche, and I'm the 401k advisor to your plan. And so today, with all of the changes to daily life, to the economy, to the stock market, in light of this coronavirus pandemic, I wanted to share with you some important things to keep in mind as it relates to your money and your 401k. So I have a few slides I want to go over with you. I'm going to go ahead and see if I can share my screen here. Let's see. Okay, so let's see. All right, so the big question is with everything going on with the coronavirus right now, what should you do now? So just as by way of introduction, I'm your, like I said, I'm your 401k advisor to your plan. And the best way to reach me is I'm still available via phone. We still have our normal office hours. All of our calls for that come into our office get routed to cell phone for staff. So we're still pretty accessible. We've been working from home for a couple weeks now. So if you need to reach me, you can still do so at the phone number below or by email as well. So I'm still working full-time and working for you. And so today, I wanted to just kind of talk about a few things that we're going to cover. First of all, I want to provide some perspective on what's happening right now and give you also some understanding. A lot of people misunderstand market cycles, and I think that's key in understanding where we are right now and what that means for you. And then I'm going to talk about 3 things that you should not do now, and then 3 things that you should do right now in light of everything that's going on. And then at the end, I'll cover the biggest question that's on most everyone's mind, I think, today. So I'm going to try to keep this brief. Right around 15 minutes is my goal, so we'll see if I can do that. So let's jump right in. Okay, so current state of the economy and the stock market. Right now, it's really just characterized by extreme uncertainty and fear. And as I record this, in the United States, there's just a lot of uncertainty. Like there's a lot we don't know about this coronavirus pandemic and how it's going to play out over the coming weeks and months. And just a telling point of all that uncertainty is that there's some pretty wide projections as far as what the death toll from the coronavirus is going to be in the United States. So one of the early studies that came out that was pretty scary from the Imperial College of Britain, they said that in the United States, the death toll is going to be as high as 2.2 million people. And then just last week, a study from the University of Washington pegged the low end at about 38,000. And then the latest I heard from the powers that be who are on this task force is probably somewhere in the $100,000 range. So, or 100,000 people range. So we really don't know what the impact of the coronavirus is going to be. And what the stock market hates more than anything else is uncertainty. So if you've been following what's been happening in the stock market, you know, the Dow Jones Industrial Average, which is kind of this barometer for stocks in general, was at over 30,000 back in February. And today, as I record this, I think it's just around 22,000, somewhere in that range. So things have changed a lot over the last few weeks, and the stock market has dropped quite a bit. Primarily because we just don't know what all of this is going to mean for businesses in the United States, the economy, the consumer, job situation, all that. There's just a tremendous amount of uncertainty. So as a result of all of that uncertainty, we've actually had the quickest fall into a bear market since the Great Depression. So a bear market is defined as a 20% or more drop from the peak. So the stock market peaked right around 30,000, like I said, and it took about, I think it was like 19 days, 19 trading days, something like that, for it to go from the top to fall over 20%. And it dropped a lot more. At one point, it was down like 35% from the peak. So pretty ugly in the stock market so far. And also, you know, it's not official yet, but it seems all but inevitable that the economy will fall into a recession. When you look at unemployment numbers, when you look at earnings, and the fact that the consumer makes up about 70% of the economy, and we're hanging out in our homes right now and nobody's spending any money, and there's just all this uncertainty, we will no doubt go into a recession. So when will this end? Like, when will the stock market stabilize and start to turn around? And of course, that's really hard to predict, but I read an analyst report last week, and the analyst kind of pegged two things that I tend to agree with. And what they said was, first of all, the infection rate needs to stabilize for the coronavirus. So if you've looked at charts, I'm sure you've no doubt seen, you know, you look and see what happens where it spikes up, but then you look at places where this started earlier, like China and South Korea, and you see this sort of stabilization in the rate of infections. That needs to happen. We're still on the upswing, where there's like the infection rate is still doubling, like, you know, every day or close to that. So that needs to stabilize. And then we also need time to sort of digest these protective measures that the government has now stepped in to take. So they just signed into law last Friday this 2.2 billion, no, trillion, not million, not billion, $1 trillion stimulus package that is designed to keep the consumer and businesses afloat during this pandemic. So we need to see what the impact is. You know, the goal is sort of that the stimulus creates this bridge, right? So right now, like, nobody's spending. It's very scary out there. It's scary for businesses. It's scary for consumers, the average American out there. A lot of people have lost their jobs or been laid off. And the idea with this is that with the stimulus, this will be a bridge so that when we come out the other side of this pandemic, which we will, we don't have to completely rebuild this economy. So that's the idea behind it. We'll see if it works. We just don't know. I mean, it was just signed into law. The checks haven't been mailed yet, and there's a lot that still needs to happen. So we don't know. But that needs to happen in order for the stock market and economic situation to stabilize. Okay, so the next thing I want to talk about, and I think it's really important to understand this. You might, on the surface of this, think that it's probably too much detail for you to care about, but stick with me here because I think it's very important. And it's actually a pretty easy thing to understand as well. So this right here, this chart that I'm showing you, it's a chart of the stock market cycle. So it's important to understand about the stock market is that, yes, it's unpredictable. It's very unpredictable, especially day to day. We don't know if it's going to be up or down or what's going to happen. But in general, you look at these longer cycles, the ups and the downs, they follow, even though they're unpredictable, they follow a very predictable emotional pattern. So you can see at the top of a market, you know, where we were a couple months ago, like tail end of last year and into this year. Stock market's at all-time high. You have the consumer who is extremely confident. People are buying houses. They're extending themselves on credit more. But there's just people are feeling very euphoric, and almost nobody thinks that the economy is anywhere near a recession. And so you have this feeling of sort of optimism, then excitement, then euphoria, and that characterizes market tops. And what's important to realize here too is that this can happen very quickly. Like you can pass through a lot of these emotional stages within days or sometimes hours. Other stages can last as long as weeks and months. And then you see on the downside, so what's happening right now is that the market started to react a little bit negatively to the coronavirus. You started to see signs of that I want to say maybe like mid-February, where there's fear. So you can see kind of halfway down that chart as it's on its way down, you have fear creeping in. And then you have panic. And that's what's been happening the last several, when you have the Dow, when it's down like 2,000 points in one day, or it loses 11% of its value in one day, or the stock market closes because it's dropping so much so fast, that's panic. And then you have capitulation, which is basically just like throwing up your hands, surrender. And then at the very bottom, you have this sense of hopelessness. So it's you know, these emotions are very similar, and sometimes it's hard to peg exactly like, are we at the bottom? See, that's the big question, is based on the emotional pulse of the stock market right now, are we at the bottom? I don't think so. I don't know. But at the bottom, you can see this arrow here. That's the point of maximum financial opportunity. So the bottom is characterized by fear and panic and hopelessness and despondency and depression. Like, this is never going to get any better. That is the time not to be selling, but to be buying. And most people make the opposite mistake. They buy at the top and they sell at the bottom. And so I want you to be very aware of these very predictable emotional cycles that the stock market goes through every single time, whether we're at the top or at the bottom or somewhere in between, because it helps you identify the opportunity. If you know that the bottom is characterized by surrender and hopelessness and the feeling that this time is different, it's not going to get any better, then you can recognize that, ooh, that's a good buying opportunity. And it's very important to be able to do that, because it keeps you from, I think, giving into the emotional temptation to sell when things, and to like liquidate your 401k and move to cash or take money out or whatever it is that causes you to panic. If you know that the market is characterized by this and those emotions come in near the bottom or at the bottom, then I think you're much less likely to actually give in to those emotions and sell. So that's why I wanted to talk about this with you, because again, even though the stock market itself is unpredictable, the stock market cycles, the ups and the downs, have a very predictable emotional pattern associated with them. And I think we're very close to that downside because we've already seen panic enter in. Now, we don't know how much longer it will last, how long it will hang out here at the bottom or near the bottom, but it does give you some hope that if people are if people are feeling hopeless and depressed, it's actually a good sign. Okay, so what should you do now about all of this, everything that's going on with the coronavirus? So I want to talk about, like I mentioned earlier, I want to talk about 3 do's, and then I'm going to talk about 3 don'ts. So actually I reversed that. So I'm going to talk about, first of all, what you should not do right now. Okay, first of all, panic and sell. Panic is a very common temptation. You see the world is seemingly coming to an end. You know, this happens in every single down market that's substantial. So it happened if you were around and investing your money back in 2007, 2008, 2009, you know what this feels like. If you're around during the tech bubble in the early 2000s, you know what this feels like. In 1987, the stock market dropped 22% in one day. People were panicking. But the worst thing that you can do in a down market with your 401k portfolio is to panic and sell. Keep in mind, this is meant to be long-term. Even if you are near retirement and you've watched your portfolio drop in value, we still have to keep this portfolio invested to fund your retirement. So even if you're just a few years away from retirement, you still have to be invested. So I encourage you not to panic and sell. if you're worried and want to rebalance, that's part of what I'm here for, is I can take a look at your portfolio, how you're invested, and give you some guidance on how you may want to rebalance, either to take advantage of what's going on or to potentially reduce your risk in the future. So there's always things that you can do, but panic and selling is not one of them. The other thing that you should not do is take a loan or withdraw your money from your account. Now, this can be very tempting depending on what your 401k plan allows. And with this new stimulus package that's passed, they've made it a little bit easier to take money out in an emergency. But that's the key, is you want to only tap into your 401k if it's an absolute emergency, and it's not meant to be used for other things. So if you have questions about this, if you feel like you don't have other options, a lot of times I can help you think about maybe some other options that you do have, and help you decide if it is a good reason to withdraw from funds from your 401k or not. The last thing is not to lose patience. Now, the longer a down market or a bear market drags on, it's just harder to deal with. And it's like, when will this ever get better? I just want to stop the bleeding. You know, so we start to lose patience as investors. And that's another big, big mistake that investors make. I don't know how long this bear market will last. I don't know when we will hit bottom. And when we do hit bottom, I do not know how long it will take to come out of that. It could be weeks, it could be months. So I put down here the average bear market, again, which is a drop of 20% or more from the top. The average bear market lasts about 14 months. Okay, so a little bit over a year. Now, they can be really short. Bear markets have lasted as little as just, I believe, 4 months since World War II is the shortest one. And then 18 months is a pretty long one. That's what we experienced back in 2007 to 2009. So they vary, of course, but on average, they last about 14 months. So as long as you know that it could be a year or longer while you have to kind of sit and wait for things to get better, it helps you to not lose patience. But it's very important to not lose patience. Okay. So let's talk about 3 things you should do now. Now, one of the best things you can do if you can afford to is increase your contributions. And the reason why is because the value of the shares of the investments that you own, the value of those pretty much across the board, unless you own everything in like a stable value or a bond fund, everything has dropped. So when you increase your contributions, you buy more shares at a cheaper price. And because you're buying into it every month, you're doing what's called dollar cost averaging, and by buying in every month. And if it continues to go down, you're buying more shares at cheaper prices. If it continues to go, if we kind of turn around and we go back up, you're still buying shares and you're increasing your contribution. So in difficult markets, one of the best things that you can do for your long-term success, if you can afford to, is increase your contributions. And that's because it allows you to buy more at a cheaper price. And I put the limits for what you can contribute this year on there as well. All right. The other thing that I think is an important consideration is Roth, either contributing more to a Roth than you were doing before or doing a Roth conversion. So Roth conversions make a lot of sense if your income has gone down or you're anticipating that it will go down. Also, the balance of your IRA or your 401k balance has dropped, so it's smaller than it was. So the amount that you're converting, again, those shares are worth less today. So it's a good time to do a conversion. Now, again, there are always opportunities in crisis, and this is one of them. So if you're not completely blinded by fear and anxiety and hopelessness and depression, you can take advantage of some of these opportunities. And one of them is a Roth conversion. Now, on the right side of the screen here, I put kind of the side-by-side difference between Roth 401ks and traditional 401ks. So you can see the big benefit of a Roth is that while you don't get the tax benefit today, or if you convert, any amount you convert would likely be subject to tax. The beauty of the Roth is that the money is never taxed again. And it's a very powerful tool for saving and planning for the long term, since you won't pay taxes on that money down the road. Okay, then the last thing that you should do is answer a very important question for yourself, and that is, am I going to be okay? Especially if you are close to retirement. If you're within 5 years of retirement, now is an ideal time to do a retirement analysis. So here's what I mean by that. So here's a scenario. We have Joe, he's 55, he's single, he wants to retire in about 6 years when he's 61. He makes really good income, he makes $90,000 a year. But he anticipates that his spending is going to go down in retirement, and he only needs $78,000 a year versus the $90,000 that he's getting now. And then I put his assets there. He's got about $576,000 saved for retirement. He's doing a really good job. And he's saving 5%. He's getting a 4% match on top of that. So 9% of his $90,000 a year salary is going into retirement. And then right now he's about 70% in stocks. He's going to have Social Security, but he won't have any other income sources in retirement. So the question is, now that we, are in the situation that we're in, Joe still wants to see if he can retire at age 61. And so here's the likelihood that Joe is going to meet his goals. If you look over to the far right, you're going to see he has a 5% chance of success. In other words, we do a Monte Carlo analysis using this data, and it basically lives Joe's retirement 1,000 times in good, bad, ugly. And of those 1,000 times, how many times did Joe run out of money? Well, unfortunately, he ran out of money about 950 of those 1,000 times. So he only has a 5% chance of not running out of money before he reaches his life expectancy. So not good. But this is important because it's a little depressing to see like, oh man, this isn't going to work out how I thought. But because he's 6 years from retirement, we have time and we can pull some levers. So I want to show you what we changed. We changed a couple of things here, and he went from 5% to 82%. So let me show you what we changed. So first of all, Joe was willing to retire a little bit later, and just by pushing his retirement back from 61 to 64, we got a good portion of the way where we needed to be. We also decreased his spending by about 38% for his per year for retirement. So realistically, based on Joe's size of his investment portfolio, it could not support those withdrawals in his income needs. So if he's willing to retire later, reduce his spending in retirement, and then also you can see the last one, if he increases his savings, the combination of those three things got him from 5% to 82%. And all those things were things that Joe could live with. He said, okay, I can retire a little bit later. I'm willing to increase my savings now and decrease my spending in retirement. So in order to do that, sorry about that. So in order to do this analysis, I can do this for you for free. And it's so critical to just seeing, am I going to be okay? We've had this huge drop in the stock market. There's a lot of uncertainty in the world right now. Am I going to be okay? And I urge you, if you are within 5 years of retirement, to take the time to do this analysis. So here's what you need to do if you do the analysis. And you probably can't see it too well, but this is a one-sheet worksheet, or 2 pages. It's just front and back. Very easy. Fill in, your basic information about whether or not you're married, when you want to retire, what you're going to receive for Social Security, other income sources that you might have in retirement other than Social Security. Maybe you have a rental property, maybe you have a pension, something like that. And then your investment assets. So you have your 401k, but if your spouse also has a plan, you want to include that. And so just filling out this one page front and back I can generate this analysis for you, and it's so telling in helping you understand where you're at today, if you're on track, and then how to get back on track if you're not. So again, if you're close to retirement, within 5 years, especially within 5 years, but you can do it at any point along the way. But the closer you are to retirement, the more accurate the results are going to be in informing when you should retire and what that should look like. So I hope that's helpful. I hope you'll take me up on the offer to do this free retirement analysis for you. It's part of what I'm able to do as the advisor to your plan. I want to support you in making smart decisions for retirement and navigating through this storm that we're currently in. Okay, so last thing, if you want daily quick tips about retirement, I actually have a podcast. It's called the 1 Minute Retirement Tip. It's on Alexa, it's on iTunes, it's on Spotify, Google Play. If you take your phone out right now and you just take the camera app open and hold it up to that little code that you see on the screen, that little scrambled image, it will pop up on iTunes. So if you have iTunes, it will show you. But otherwise, you can just search for 1 Minute Retirement Tip and subscribe there. They're super quick. Most episodes are 2 to 4 minutes long. And I talk about things like the coronavirus and what you should do now and what we covered today, and a wide variety of other retirement topics. So there's lots to cover. Retirement's it's one of the most important financial decisions you will ever make. And my goal with this podcast is to help you and all of the listeners who listen to it make smart decisions for retirement. So thank you so much for tuning in and watching this video. I hope it was helpful in giving you some perspective in how to kind of think about this current crisis that we're in. Again, if you have any questions, please feel free to email me or you can call me. I answer, there's probably not a question that I haven't heard at this point. I've been doing this for over almost 13 years now, and I went through the last financial crisis. I was in the industry advising clients back then. So I've been through difficult markets before, and we will come out the other side. It may take some time, but until then, I'm here for you if you have any questions. So please, I hope you'll reach out if you do. So thank you so much. I really appreciate it. And again, if you have any questions, please email me, please call me. I hope this was helpful, and I will hopefully talk to you all soon. Bye-bye now.